All right, why don't we go ahead and get started. I think you guys can all see my screen here. We're going to talk a little bit about tax optimization, charitable giving. Before we get started, I'm Brian Windsor. I am a Vice President, Financial Advisor here at Bogart Wealth, located in our international headquarters in McLean, Virginia. I, along with a lot of the other team, work here in McLean, but we also have other offices, as we'll see, externally in Texas. So if you're new to us, welcome. Good to have you guys here. And for all of existing clients, happy that you're continuously following the service model and finding value adds in these conversations and joining us today. I believe the webinar is going to last about 45 minutes to an hour today. That's the time that we have allotted. We're going to go through the presentation today. If you have questions, I have the chat box opened. I'll do my best if I can to get to all of that, but we'll also maybe leave some time towards the end of the conversation today for that Q&A, and we'll do our best to answer your questions. So let's get started. We'll talk a little bit about the firm. We're going to talk about the agenda, what we're going to be covering today, really a refreshing of what the current tax laws are, what are some of the upcoming changes that we need to be prepared for, and then what actionable items can I actually take place today, whether I'm in accumulation phase, whether I'm in that early retirement or getting near to be retirement, what are some of the things I need to be thinking about, and then if I'm in a different phase of my life, kind of thinking about sort of that estate plan and where maybe charitable giving fits into all of that. So looking forward to having a good conversation today. Again, chat feature will be open. I'll try my best to get to that, but I'll be probably looking more at that towards the end of the conversation today. All right. So if you're new to us, let me explain. Bogart Wealth is an independent registered investment advisory firm based here in McLean, Virginia. We are a fiduciary financial advisor for our clients. We have about 1,300 households that look to us as their primary financial advisor. We want to be that first person that you call when you have a financial related question, whether it's about affording a new home, whether it's going to be thinking about a new grandchild that's coming. We can be that first call for you and help figure all this out for you. We are a fee-only firm. So as our clients know, we only get paid off what our clients pay us to manage their investable assets. But outside of the investing portion, I do think we offer a lot of additional value, specifically on the financial planning side and tax optimization. A lot of that what we're going to be talking about today. Let's go to the next one. The size of the firm is growing, especially for you clients that I know that have been with us for quite a number of years. These booklets looked a little bit different just 3 or 4 years ago. I myself have been with Bogart Wealth for the last 2 years. I have about 18 years of financial industry experience. The firm itself is growing. We're almost at about 40 employees nationwide. But the core of what we are is our advisory team. Our advisory team, led by many certified financial planners and our CEO, James Bogart. Our mission is to help provide peace of mind for our clients when it comes to making big lifetime financial decisions. So our advisory team is located here as well as in the Texas area, as well as our other departments. We have our compliance team, marketing, our investment management team. All of that is done in-house. Our financial planning team, as you see here, is all done in-house. So just to give you a size and scope of Bogart Wealth, the type of firm that we are is that everything we do here. We don't farm anything out. We don't contract things when it comes time for our clients and their financial plan. All right, there is the investment team there. That's kind of what you would expect an investment team to look like, right? When you look at these sharp-looking guys, these guys are managing assets. One of our key disciplines is that deeper financial planning. Comprehensive wealth planning is what we offer for our clients. Today, we're focusing on one piece of this, but to provide context of the additional value that if you're an existing Bogart Wealth client and you want to see more, or if you're a newer client or a prospect to us and you want to know what is it all that the firm does. I mentioned the investment management piece. Yes, that's how we generate the revenue for the firm. But at the core of what we do, it's also that comprehensive planning. And this is what you see right here on the screen, really helping our clients find out, number one, am I on track to be able to pay the bills in retirement? That's usually what the biggest question we get day in and day out is. But it doesn't stop there. We go one, maybe 5 steps ahead of that, is figuring, okay, now that we can retire, what's the best way to think about, generating cash flow? That plays really big into this next piece that we're going to be talking about today, tax planning and tax optimization. And sort of thinking about where you are now, but where are you going to be in the future? And then when you're thinking about how your cash flow is aligned, right? Okay, we now know our tax strategy. We now know cash flow. Okay, then here's the investments. How should each of these sources of monies be managed to the time frame of when I'm taking the assets? If I'm going to be taking account X out for cash flow now versus account Y, my financial plan says I'm not touching that for 15 or 20 years. I think you might want to tailor that investment approach a little bit differently between one and the other. So that's what we can help with. And then lastly, as we think about, we're not here forever. We know that our time is limited, but we worked really hard for these assets. And we want to make sure that they're passed on and used the way that we want them to be. So even just as simple as having beneficiary discussions, but more importantly, reviewing of your estate, what updates do you need to make? And some of the things we're going to be talking about today may cause you to think about calling your estate attorney to see what updates you need to make. And then part of that is that monitoring and working with you on an ongoing basis. We usually work with our clients on a quarterly basis. Okay, before we jump into this, if you are in the tax optimization one that we had, I think I did that in October, we have disclaimers. We are not tax advisors. I myself, certified financial planner. I am not a licensed CPA. But we are going to be talking a lot about our familiarity with the financial planning process and how taxes come into play. And we are pretty familiar with what current tax law is. This presentation is not designed to be used as tax advice. If you are looking for specific tax advice, that's where we need to get the CPA on the line and see what they have to say about it. But today we're going to provide you a pretty good overview. Okay, here we go. Again, we're not tax advisors, but this information is contained as of April 1st of this year. Contact your qualified tax advisor. One more line here that we're not tax advisors. We're not an accounting firm. If you want a written disclosure of our advisory services and our offering, let me know. We can get that information for you. Okay. Here's what we're talking about today. We're going to cover the Secure Act 2.0. That got passed a few years ago, so a couple of updates that if you don't know, we want to make you aware of when it comes time to things like required distributions and timing, inherited accounts, those sorts of things. I mentioned, hey, some taxes are changing, right? Guys, it's no longer, hey, it's a few years down the road. This is happening at the end of next year, right? So we're in a situation now that unless Congress makes any sort of changes, we have an understanding that there's going to be some changes to our tax code. And what are some of the things about now versus in the future we should be considering? And then here's the strategies we're going to cover today. Backdoor Roth conversions, Roth conversion analysis, thinking about net unrealized appreciation, if you have that concentrated stock in your workplace plan, talk about capital gains, loss harvesting, and then lastly, charitable giving, donor advised funds. And where does that fit into your estate plan? A couple things we'll highlight there. Okay. So now getting into some of the agenda, the items, and going through this specifically, we're going to talk about the Secure 2.0 Act. I'm hitting it very high level right now. Just so you're aware, Bogart Wealth Learning Series on our website. We have special presentations, and I think we have a special white paper specifically for the Secure 2.0. So if you want more information, please feel free, bogartwealth.com, go to our video series. You can see the one Misty did a few months ago. It's fantastic. I trust you. It's a good use of your time. It's passed back in 2022. What did it do? Well, a couple things. Change timeframes of those required minimum distributions. If you don't know what a required minimum distribution is, at a certain time of your life, IRS comes knocking on your door and say, hey, you've let so much money grow tax deferred in your pre-tax retirement accounts. Now that you're hitting the age of what was 70 and a half, then 72, then maybe 73 or 75 for some, it's time for you to take a distribution from these accounts because we want our tax revenue, right? That's what our required distributions are. We forecast that within our financial planning models. But they changed the rules, right? So what happens is that if you hadn't been of age to take required distributions, we'll see this in a few moments, that they just extended it. So got pushed down a little bit further, 73, 75. If you are implementing some Roth conversion strategies within your financial plan, which, looking at the client list, I know some of us are, that allows us maybe a little bit more time. Why? Because we don't have the required distributions adding to ordinary income. We'll discuss where that means in a few moments. For those that like to forget a little bit, maybe be lapse-minded, nice thing is that the IRS changed the penalties. Okay, so if you don't take those required distributions, you used to be penalized 50% of what you should have. Now they just reduced that to 25%, so that's a little bit nicer. But let's not forget, if you are a client of Bogart Wealth, and if you know us, we make sure you don't forget about taking your required distribution. Catch-up limits have been now increased for inflation, for contributions. The opportunity to roll over a 529 to a Roth IRA. This is new, just this year. Now you can start doing it. It's sort of changed even personally. A little bit backstory about myself. I got 3 young kids, 6, 4, and sort of almost 2. And when we do our financial planning, a lot of what we looked at is, okay, well, we might not want to specifically look to overfund our kids' college education. Like retirement, we're comfortable overfunding it. It gives us more flexibility. With our children's 529s, if you know anything about 529 plans, if you don't use it and then you have to take it back, you're not only taxed, but you're also penalized for it, right? So you're paying extra money for that. This is sort of changing a little bit now for me and my wife's conversation, because they are going to allow you to take some of that 529 money, as long as you have the account open for at least 15 years, and then you can use that as a rollover to your child's Roth IRA, which provides tax-free growth, tax-free withdrawals in retirement, and no required distributions. So interesting things. If you need to know more about that, contact us. We'll go through that with you and how that can work with your situation. Companies can now make their company contributions to Roth 401ks. Keep in mind, one thing to know, if you are interested that your employer is offering the opportunity to do employer-based contributions, because they typically did it pre-tax and then just got a deduction for it, but now they have the opportunity of doing it as Roth. If you like that idea, speak to a professional about that, because what that could do is add additional income for the year, which you don't necessarily see, but it is going to be on your tax return. So that could also change your tax situation today. And we're going to talk a little bit about today about when does Roths makes more sense or maybe less sense based off of your tax situation. Many other topics that we have. This is just some high-level points that I wanted to cover with you. Mentioning the required distributions changing. Yeah, if you hadn't taken it yet, it's now 73 as long as you were born before the age of 1960. So for those born between 51 and 59, your required distributions now push back to the age of 73. If you're born in 1960, you are now not required to the age of 75 to start taking those required distributions. So, I think that this is one of the most important things about why have a financial advisor, why have an investment firm that can help me understand these changes and what it means to my plan specifically, because by having somebody that can look at that and say, well, I was born in 62, I was going to have to take required distributions at a certain time. Now that's extended. What are some of the things I need to be thinking about prepping myself for retirement of now knowing this information? How's that going to impact me? So as these changes happen, and I know a lot of our clients here know that we can respond pretty quickly with updates to the plan and really advice behind it. So provide a little bit of information what's in it. That's at Secure 2.0. What's not in it? What are they not restricting us, or what have they not changed? They have not changed anything on the Backdoor Roths. Not changing anything on Mega Backdoor either. So there's been talk. Maybe those things could happen, where they could put back limits on your income for being able to do things like conversions. Remember, they got rid of that in like 2010. You used to, if you made a certain amount of money, you couldn't even convert, right? that's gone. But is that going to come back? Again, having somebody that you can work with that understands this is going to be important. QCDs, qualified charitable distributions. We'll talk about that towards the end, but mainly if you have these required distributions, a lot of ways if you like to give to charity, well, that could be a really excellent way to do that once you turn that age, because I can move money from my IRAs that I would have to pay taxes on, but instead, if I just move that to my favorite charities, that's not added to my income. I don't get a deduction, but it's not added to my income, right? So I don't have that amount to take out anymore. So that's helpful. But even as required distributions have changed, the original 70 and a half, which was the original required distribution age date, that still remains. They haven't changed that. Don't know why specifically, but even if you're 70 and a half, you can still make those qualified charitables. And then the 10-year rule for beneficiaries of inherited IRAs remain the same. That's certainly going to be an impact when we talk about tax planning as well, because understanding a lot of our clients' wealth is in pre-tax assets. Now, when their heirs receive it, their non-spouses, like mainly their kids. If I leave it to my kids, or if say I'm the last to go, my wife and I, then it goes to our children, they now have 10 years of withdrawal, all that pre-tax money out. So it used to be a little bit different. Now it's a 10-year window. So it's a little bit tighter and maybe provides us a call to maybe do some things while we're still alive and ahead of that. All right. So I mentioned taxes are changing, right? That was a part of the overview of the opening of the agenda. How are they changing? Well, a couple things are happening. What you see right now is our tax rates here, the 10, 12, 22, 24, 32, 37. They're all going up as the Tax Cuts and Jobs Act fades in 2025. So this is starting in 2026. But you can see on the right-hand side here, now that's the 10, 15, 25, 28, 33, 39, 6. So for everyone, their income tax rates are expected to go up by at least 3, if not 4%. Unless you're in the 32, 33. But yeah, everything's going up. They are bringing back personal exemptions, but standard deductions are going to be cut in half. Bottom line, most households will see an increase in taxes starting in just a year and a half now, right? So again, it always kind of felt like, oh, that'll happen when it happens. I mean, here it is. It's happening unless Congress makes any sort of changes. Additional things that haven't changed, that's not changing with the Tax Cuts and Jobs Act. IRA contributions are going to stay the same. Rollover rules as far as pre-tax IRAs, being able to take net unrealized appreciation, all of this is staying the same. Nothing drastically is changing overview here. We're going to talk a little bit about how much we can put into our accounts and what are some of the benefits from a tax standpoint. Again, we want to use this webinar as a way to talk to all individuals, those that are still saving and even those that are in that transitionary phase, and also the ones that are towards the end of retirement and sort of thinking about how this all works. So as we talk a little bit about what we can put into our retirement accounts, we have our traditional IRAs that we can put monies into. We have both the deductible and non-deductible. Anyone can put money into an IRA account as long as you have wages. It just depends on can you deduct it from your taxes or not. And if you can deduct it from your taxes, you got the income limits on the right. So if I'm a single filer, $77,000 of income or less, I can contribute $7,000. If I'm over the age of 50, I got my catch-up. I can do another $1,000 on top of that. So if I make, $75,000 a year, I can put $8,000 into my IRA if I'm over 50 and deduct that from my taxes. So I'm getting lower taxes because I'm putting my money away and they're giving me a deduction for it. Joint, hey, married, I have a little bit bigger of a window that I can put money into. But if I make more than that, right? If I make, double the amount or whatever it is, I can still put money in traditional sources. I just can't deduct it off my taxes. So I put an after-tax amount of money in there, and then the pre-tax monies grow tax deferred. Roth monies, different. I don't get a tax deduction for it, right? So benefits of the traditional, if my income's in a certain place, I can actually lower my taxable income, pay less in taxes. Roth, I don't get that. It's this after-tax money that goes into the retirement account. And then based off the right, there's income limits of, well, can I actually do this or not? Well, if I make less than 146, absolutely. joint less than 230. And then there's the phase out on the right-hand side as far as, in between those amounts, there's a phase out between it. But if we didn't mention it, I think we did earlier, but after-tax money goes in to retirement, grows tax deferred, no taxes along the way. And then when you withdraw the money, no taxes either. I mean, we just saw that tax rates are going up in a year and a half. Tax rates continue to go up in the future, which is, I know, a big concern for a lot of clients. The Roth source can make a lot of sense. But Brian, I love that idea for the Roth. That's great, but I make more than the 143 you just mentioned, or more. My wife and I make more than the 230. How can I get more money in there into the Roth? Well, here's the backdoor Roth conversion, where I can make a contribution to a traditional IRA, right? We just said that. Anyone can make that regardless of income. I can put it in there. Now, I don't get a tax deduction. I'm just filing it as a non-deductible contribution. You file that on your tax return, okay? But then I say, okay, well, anyone can convert, Brian. You said there's no income limits on conversions. I can now just move that over to a Roth. Yeah, absolutely. You can do it very quickly, actually. And if I have no gain on that IRA, because I've just put it into a cash position, or just, that's where most IRAs goes into their sweep account. So it'll go right there, and then I convert it. I have no pre-tax monies in there, so it's not a taxable event. That's assuming I have no other pre-tax IRA assets. If you do, then it's used as a pro rata of what you have pre-tax versus this after-tax contribution. But if you have none other, right, especially if you're just getting started, or all of your pre-tax assets are in your workplace plans, this could be a nice idea, depending upon how your financial plan is being looked at. So that's what we do on the individual side. That's the IRAs. Let's talk a little bit about workplace plans. We're saving, we're working. What can we do with our employer-based plan? Number one, hey guys, there's no income limits to this. So if you make those higher incomes that we just talked about, like the 143s, maybe above 230, that doesn't matter when it comes to your workplace plans, whether you have pre-tax sources or Roth sources. You can put money in there regardless of your income. So that's a nice big perk of the workplace plans from a salary perspective. But 2024, if I'm under the age of 50, 23 grand can go into that account. If I'm over 50, I can do that additional catch-up contribution. So another $7,500. And then we have the total amount of money that can go into a deferred contribution plan, which is like your 401k, 403b, $69,000. So between yourself, your employer, that's the max that can go in. Tax strategies, sale of primary residence. So a lot of clients, when they get ready to retire or they think about downsizing, they have to think about what the tax consequences are of selling their primary home. The good news is the IRS has the primary residence exclusion that you can utilize. Assuming that you lived in your home for 2 out of the last 5 years, an individual can exclude $250,000 as an individual, $500 joint, of gains from selling your home. So if I look at what I paid for the home, what I put into it, right, adjusting my basis, if I put money into my home, the IRS allows me to adjust the basis of my home. And then between the basis and what I sell it for, assuming, husband and wife, $500,000, if that's the gain, that's all tax-free. So selling a home is actually a very, from a tax perspective, a very nice thing to consider. It's just, where are you at in your stage of life, and, mortgage rates as well too, right? So that's a difficult time to be thinking about making those changes, but I know a lot of us are, especially if we can just buy the home flat out. Okay, cost basis rules, and then we get into Social Security. So from a non-retirement perspective, investments, I have my individual shares, and I purchased them at different times. Cost basis rules allows us to be able to sell specific tax lots. So if you are thinking about, well, I have this large expense upcoming, whether it's a new car, my daughter's getting married, need to think about ways to start generating monies from my investment portfolio. Maybe I don't want to take it from my IRAs because that's ordinary income. Maybe I'm under 59.5. I have my stock portfolio and I'm going to take a look at it. I could just sell it, and depending upon whatever the accounting method that they use, that's just how the taxes are going to be paid, or what the gains are going to be. But you can actually look at each individual tax lot and say, well, I just want to sell this one here specifically. Why? Because it, maybe it's running a loss, or maybe it doesn't have a large of a gain associated with it. So you can, not have to pay a lot of taxes for it. If you don't have it on file, as long as you let Schwab know within 2 days of settlement, we can then identify the tax lot within 2 days. All right, Social Security taxes, 6.2% up to the first $168,000. That's also you, that's your employer, that's what you're paying into it. Currently, right now, I'd be curious to know what everyone's thoughts are about this 168 number now, with some of the latest news about Social Security and some of the lingo they've been putting out there as far as what's going to happen in 2035, 2036. Medicare taxes, that's up there first, $200,000 for single, $250,000 for joint. That's 1.45%, shared by both you and your employer. And then if you have income in excess of those amounts, then you have the Medicare surtax of 0.9% from your paycheck. The Obamacare tax, if you're not aware of this, is that if your income is over 200 as a single filer, 250 as a married filing jointly, that there's an additional 3.8% surtax on what's either your net investment income, which is a tally of all your dividends, interest, capital gains, right? Everything you've earned from investments. That's not retirement, by the way. Retirement's a completely separate vehicle. That's all the tax bubble there. But this is just non-retirement monies. Then that amount, or the excess of your modified income above this amount. So say you're a joint filer and you have modified adjusted gross income over $250,000. Let's say it's $300,000. So you have a $50,000 excess. So it's the lesser of the two: net investment income or what you have over the modified adjusted gross income. Whichever is less, then that amount of money has an additional 3.8% tax. We usually get a lot of questions about that. Ordinary income tax rates. Okay, so this is our tax brackets right now. We mentioned this is changing. This is for single filers. Here's your 12, 22, 24, 32. And then on the right, here's our average rate. So common misconception. I can't. We have a family member, as I'll tell this story here. We have a family member that at one point stopped working towards the end of a year, 1 year. And his reason is because I don't want to put myself into a higher tax bracket. I tried to discuss the differences between actual, a progressive system like we have here, where it's marginal rates, as opposed to just everything being taxed at that same amount. Didn't go so well, but nonetheless, it's a very common misconception, right? So what that means is any income right now that I earn between 0 and 11,000, that's at a 10% rate. Income above that 11,600 is taxable at 12% up to the 47. So then the 47 to 100 in this case is the 22% tax bracket. It's not like, well, if I make, $60,000, everything's at 22%. No, it's a marginal rate tax at certain levels. These are the ones I know a lot of clients are familiar with. The joint brackets, and based off of your income, that's where your marginal rate is. Average rate on the right-hand side, that's your actual rate that you're paying, right? So if I make more income, my average rate might tick up, but it's not jumping up brackets. Estate brackets. These are tough to look at. I know a lot of us know this, but estate taxes are rough. Any income that an estate or trusts accumulate above 15 grand, 15,200 is taxed at the 37% tax bracket. Hey, that's tough. So right now, estate tax laws are pretty loose. We're actually going to talk a little bit about that. We'll talk about that in a second. But meaning I can leave a lot of money right now to my heirs, over $11 million each between me and my spouse, or $13 million from each of my spouse, and not have to worry about this number. But if that changes, then it can be a little bit. You're going to pay a lot more in estate taxes, right? Because if that number changes, which it's supposed to sunset, right? So that's part of the Tax Cuts and Jobs Act, where right now This like 13 million that you can leave is supposed to be adjusted back for 2016 numbers, adjusted for inflation. So that's maybe what, 5 or 6 million per person. So you and your spouse can leave maybe what, between 11 and 12 million maybe. It's a big difference from the 26 right now. That could be subjected to estate taxes. So contact your advisor, get a plan in place. If you need to know a little bit more about that, we're happy to help. One other thing that we'll talk about is the Kiddie Tax. So it's if you set a uniform transfer to minor account, otherwise known as UTMA, you set it up. It's an irrevocable gift for this child, your child, grandchild. It's an irrevocable gift that it's for the child when they turn 18 for most areas. But the first $1,300 of unearned income, meaning like dividends and interest, it's all tax-free. The next $1,300 is at a child rate, 10%, and then any additional above that that's at the parent's marginal rate. So again, for thinking about saving monies for our children, our grandchildren, from a tax perspective, the 529s are excellent tools because they are tax shielded vehicles. As long as you have your state's plan, some states offer you a state tax deduction for those that actually have state taxes. And as long as you use those expenses for college, 529s are tax-free as far as distributions go. So depending on what your goals are for saving for your loved ones, your heirs, specifically if they're younger, like I'm thinking like my kids, right, under the 6 and under, 529 is great because that's going to help for college expenses. But 529s are restrictive in the sense that that's all they allow for. New rules allow some conversions from 529s to the Roth. That number is like 35,000. But so might be okay for some, might not be for all. The Roth is then just generally for retirement. These are uniform transfer to minor accounts, which mainly is like it's a gift to them when they're 18. So I'd like to give them a step up when they turn 18. I like to make sure that these monies are available for them if they don't want to go to college. These accounts come up with a little bit of a tax advantage. Dividends, capital gain rates. We'll see here that those are taxed a little bit differently. So if you don't know, income rates were the slide before. That's like wages, pensions, just normal work. And then you have your capital gains and qualified dividend rates, which are a lot more favorable for most. In fact, for clients that can get a joint income of less than $94,000 after deductions, they're at a 0% tax rate. So I don't know if some of my clients are here, but we were able to sell with a few clients, some accounts or some shares, and from their portfolio one year by doing the tax prep ahead of time in conjunction with our tax team, we're able to kind of figure out, hey, here's how much capital gains you can incur with still staying in a 0% tax bracket. Boom, I tell my trading team, clients get monies, no taxes due, everyone's happy. But then as you go up the brackets, 15, 20% or so, depending what your total income is. And keep in mind your capital gains, qualified dividends, they are taxed on top of your income, on top of your wages. So obtaining more capital gains and qualified dividends won't push your federal income brackets up. That's seen as separate. It will, though, be all pushed together for your state taxes, as most states don't, separate between capital gains, dividends, or income. I know a lot of clients we talk to, these Medicare premiums, man, these things are pesky, right? When you get those slips and, telling you how much you're going to owe, and just, based off your income, 2 years ago, you're going to have to pay, taxes for, not pay taxes, but just higher Medicare premiums if possible. So right now we're in 2024, where Medicare premiums work. If you are over the age of 65 and part of the Medicare system, based off your 2022 income, that's how they decide exactly how much you pay, and then so on and so forth, it readjusts. So that's based off of your income, and that's your Part B, Part D cost. You can see that, the bigger jumps happen, around higher than 258 if you're a joint filer. That's when it goes up $100, and then another $100 again on top of that after it goes up 322. So if you have one big year of a windfall, whether it's like a deferred compensation plan, whether you sold like a lot of large, shares at large capital gains, that could have some impact to what your Medicare premiums are going to be 2 years from now. So keep that in mind, just in the back burner. One thing that I do for a lot of clients is that, and what our financial planning team does is we're thinking about what these Medicare premiums can do to their plan. We actually can add in, when we do add increased costs to healthcare expenses. So you can kind of see, well, if I'm thinking about doing this, okay, and that looks good, but how's that going to impact this, and what's the best decision, right? So how do the dominoes fall? We got you, right? This is what we do. This is how we can show you. And saying like, hey, maybe it's justified to pay these higher premiums, right? Maybe it's not. Let's let the numbers show them for themselves. All right, guys. So that's a highlight of the tax system. We talked a little bit about some strategies there, but now we're going to spend the last little bit here talking specifically about strategies that we can implement while we are working, strategies as we're transitioning or in retirement or towards the end. Our list of items, we're going to talk about those backdoor conversions, contributions again. We're going to talk a little bit more about the Roth conversions, NUA, cap gains, and tax loss harvesting, which may be my favorite subject, and then donor advised funds. So while you're working, while you're saving, workplace plans, best thing you can do for a lot of individuals because of the ability to set up and save more for retirement. Remember, we saw that IRA is only like $7,000 or $1,000 if you're an additional $1,000 if you're over 50. With your workplace plans, that number is, $26,000, right? It's just a lot more that you can put in there, right? So by able to put more in there, there's more benefits for growth in the future. When you save on a pre-tax basis, you are lowering your taxable income. Okay, lower taxes, that's great. I'm in a higher income now, I'm working. I want to lower my taxes as much as possible. Saving on a pre-tax basis can do that. The bad part, you're going to pay taxes on that eventually, right? So you can't hide from the IRS. And if you wanted to take it before 59 and a half, there's a penalty, right? So this is designed for retirement. They will allow you to defer that tax, right? But they say you can't touch it till at least you're 59 and a half. And then no matter what, as we talked about, by the time you're 73 or 75, you'll have to take those required distributions. So tax-deferred vehicles, save money in, pay money out in the future. Roth accounts, Roth 401ks, different story. After-tax monies, I don't get deductions for it today. But I get tax-deferred growth. No interest, no dividend. I don't pay anything along the way. It's all my tax bubble. And then when I withdraw it, assuming I've had the account for 5 years, assuming that I'm at least 59 and a half, when I withdraw that, that's completely tax-free to me. Last line, beneficiaries inherit tax-free. We're going to see an example in the next few minutes when we talk about Roth conversions and benefits it can provide, but to tie in what we talked about the Secure Act. Going to tie in about how that can be impactful for Roths. When you pass away, husband and wife, portability. I can make my spouse's IRA my own, my spouse the same. So it's portability between the spouses. But that next generation, anyone that's a non-spouse, kids, cousins, uncles, whoever that person is, when they receive those funds, they have a 10-year clock now. Any IRA, any 401k, any retirement account, they have a 10-year clock now to start. It used to be, if you inherited from like mom or dad, grandma, grandpa, before 2020, before the original Secure Act, you had to take minimum distributions for your lifetime based off your age. So if you're, 40 or 50 years of age, which I consider relatively young, the amount you had to take out was pretty small. So that allowed the rest of the money to still grow. Fast forward to today, not the case. I got a 10-year window to withdraw this money. Oh yeah, these pre-tax monies get taxed on the way out. So here it is, my life savings, I grow and accumulate my retirement assets only for when my kids get it, they have to take it out over a 10-year period. Where are they in their stage of life and their careers? Financially, how are they doing? Because they're about to have to take all of my retirement account over a 10-year period. What does that do to their tax bracket? Yeah. Roths are a different story. They still have that 10-year window that's associated with it where it has to be withdrawn, but it's not taxable to them. So part of the benefits of a Roth is that is bequeathing them an additional 10 years of tax-free growth, assuming they keep the monies in the account. Let's talk Roth conversions now. What are the benefits of doing this? We mentioned it. Okay, it could be from the estate perspective. But what it is I'm going to take money out of my pre-tax money, pay taxes on it today based off my income. And I'm going to move that to my Roth. So anyone can do this. Anyone can pick up their pre-tax monies, their individual retirement accounts, and they can move it to their Roth. That a dollar amount, that will be taxed at ordinary income today in today's tax rates. So conceptually, real easy to think about. If I'm in high tax brackets today, I'm expected to be in low tax brackets in the future, maybe not. I want to consider not paying the taxes on that money when I'm in high income brackets. If I'm in a low income bracket now, maybe I just retired, and in the future I'm going to have pretty high required distributions, meaning my tax rate's low today, tax rate's going to be high in the future. Maybe I consider Roths today. Maybe I convert some of that money now when I'm at my lower tax rates versus having to pay it higher rates in the future. We can help, right? So part of the financial planning process for us is looking at estimates on your taxes for today and also all throughout your retirement. So we can help analyze and find out if there's any tax bombs or tax snowballs that you need to be worried about, and we'll help figure it out what's the best way of making or approaching that. Talked about that backdoor Roth IRA contribution, goes into your traditional IRA, and then we immediately convert it. So that's what you can do. Anyone can do that. But what can you do while you're working, and what are some of the unique things you can do with your company's workplace plan? I got first started in the industry on the workplace side. I will tell you every 401k plan is different. They're just different, and not everyone's the same. However, within your financial plan, working with us and working with the advisor, we can help determine, hey, it would make sense or be very helpful for you to help put more money towards retirement. And also, maybe we want to get some more monies into the Roth because we see some things in the future that are telling us that more money in a Roth today is probably better. You can do what's called the mega backdoor. Mega backdoor is I can make an after-tax contribution into my 401k. So remember, $69,000. That was the amount of money that we could put into our workplace plans between myself and the employer. That $20,000 or so of your money, that's from your specific wages. Between $69,000, some employers are going to allow you to basically just write a check to max out what you and your employer are putting into the workplace plan. That's what's called an after-tax contribution. Contact your workplace plan to see, hey, can I put more money in? Then that's going to go into a traditional IRA, a traditional 401k source. So now you just got this basis of money after taxes that are in there. Oh, and what if they allow you, again, this is why you got to contact the plan provider, to then immediately convert that to a Roth source. Again, it's just the same thing as the backdoor. I'm just putting it here temporarily and moving it over. Tax-free exchange, being able to put more money into your workplace plan. So again, not every company is going to allow you to do this, guys, but pick up the phone, whoever you get your statement from, call them. If you need our help and you're a client of ours, we're absolutely willing to help. Some plans on the way out of your 401k, you have maybe been able to save more than that $26,000 we just talked about, and they allow you to put an after-tax amount of money through payroll deductions. We just talked about you doing an after-tax contribution, just writing a check, but a lot of times they allow you to do after-tax source as what's called a spillover, right, into the 401k. I'm going to put a little bit more in now that I've done my pre-tax stuff. This is just after-tax money that I'm putting in as a spillover. So on the way out, some plans, I know a lot of y'all know what this statement looks like, is really then say, okay, I have a basis of money I put in my workplace plan, and by doing this, I'm going to take this basis and I'm going to convert it either within my plan, or if I roll over the account, that's the amount that I'm rolling over to a Roth IRA. Use that after-tax contribution basis, what you've put in. Guy who creates the slide, not this. Love that. But not that. Not that source of money's basis plus earnings. That when this says after-tax account, that number 562 on the right. So that's like everything you got in that source of money, which is everything you put in, everything that's earned. No, That's not the amount. The amount is the 270. That's the exact amount that you've put in. We do have a great video on the Mega Backdoor too, by the way, on our website. Roth conversion analysis. So again, simply put, remember, think about that, that be mindful of where your tax brackets are today and where they are in the future. If I'm making conversions, they're done at the marginal tax rate today, meaning if I'm in that 22% tax bracket and I do the conversions that are going to push me up into the 24, then that conversion is now a 24%, right? That's what it's causing me in taxes from the federal perspective. That's at the marginal rate. My tax savings are at a future average tax rates. So most clients defer Roth conversions until they retire into their retirement when their income rates are lower. I was just having a debate actually with a colleague about this. That's not an exact science, right? So these are generalized, things to be thinking about, especially if we're towards the tail end of our career. But there's something also be said about time value. And if you're in your 30s or 40s and you're thinking about Roth conversions, even if you're, in a good situation financially where you're maybe in the 24, 32% tax bracket, but you have more time on your side as opposed to, well, I'm going to retire right now. And then, okay, your time value, unfortunately, is a little bit more diminished. But for the younger generation, 30s and 40s, yes, even if I'm paying more taxes today, I have a lot of time to make up for that. And that Roth could provide me a good source for that. So again, I don't want to generalize. Seek us from a planning perspective to determine what makes the most sense of where you are. So reasons you want to consider it. My average income rates in the future will be higher than marginal tax rates today. Provides diversification of tax exposure. Yeah, you'll be in RMD prison. Part of the financial planning process is we factor in what your required distributions are going to look like in the future. And a lot of times it's like a tax bomb almost, where you just all of a sudden see this, and everything just jumps up. That's what the creator of this presentation calls RMD prison. You could probably come up with a better name than that, RMD prison. But nonetheless, if you get money out of the pre-tax sources now, then certainly that's going to be helpful where you won't have to pay that for required distributions in the future. Because also with required distributions, they go up, right? We'll see this in a second. Those amounts go up regardless of what the markets are doing or what your portfolio is doing. The percentage the IRS requires you to take goes up every single year. So this is what we're talking about as far as your marginal rate versus your average rate. So if I'm converting now, I'm converting my marginal rate. Right? So that's going to be, again, pushing me up to the 22, 24% tax bracket. But then the actual amount of money that I'm paying on taxes on everything is the average rate. So if I'm in a higher rate earlier on, maybe not so much if my marginal rate's higher than what my average rate's going to be. Again, if it's the other way around, specifically for a lot of clients that are at retirement in their first couple of years, usually we find that to be their lowest tax years. Marginal rate's low. Then average rate in the future is going to be a lot higher because they have those heavy required distributions, or even when Social Security kicks in, you may want to consider Roth conversions. Talked about this. No required distributions for Roth. Here's what I'm talking about, guys. Look at this. I mean, we'd be so lucky to live to 120. Well, I don't know if we'd be lucky to live that long. Some people might say like, hey, Brian, once I hit 90 or 100, you know what I'm saying? But no, nonetheless, if you look at the percentage that you're taking at required distribution age, you're thinking about like around 4% or so, top left-hand corner here, you're taking 4% or so from the portfolio. But look how that money, by the time you're 80, it's 5. By the time you're 90, it's 8.2%. We're all living longer. That's just facts, right? And so what this is going to do is require us to see that more and more has to come from our portfolio. And then also think about where tax rates are going to be. I've been doing this a long time. I don't know many people that are very optimistic that tax rates are going to be lower when they're in their 80s or 90s than they are today. I think you would think my assumption is that they're going to be higher. So maybe a benefit for the Roth is that if I pay in today's lower tax rates, I don't have to pay it as much in the future. Reasons to convert: surplus required distributions. Yeah. You got all these required distributions and you don't need it for income. So why are you paying taxes on that money? by looking at that ahead of time, right, and partnering with your financial advisor, partnering with us, we're going to tell you that. So if you do have large surplus RMDs, maybe do the Roth 401k now, right? Again, talk to us, because your income and how that affects your taxes can play into that. But consider it, right? I have enough pre-tax money. I'm going to do my Roth 401k now. Do a Roth IRA now. Do some conversions. Consider gifting to fund a Roth IRA for working kids. Just keep in mind the 5-year rule. So just have a Roth IRA open within 5 years. This slide is, do you convert or not convert? Again, these are sort of generalized statements. Seek help from your financial advisor to determine if it makes the most sense for you. Here's that visual here of a client that just retired in 2023. You can see in 2023, this is showing their marginal tax bracket throughout the rest of their life. We're going to assume that this individual lives to the age of 90. And they turned 75 in the year of 2037. So that's when they have to take required distributions out. So our detailed financial planning is going to look at, okay, where their cash flow is going to come from. We're going to help them determine that, what's the most optimal. And in this case, the cash flow and investment strategy that we drive is going to help keep their tax rate relatively low these first few years of retirement. Top right-hand corner showing us, 10% marginal rate. But in the future, when they hit that required distribution age, 33% tax bracket, and that's there forever, whoa. If I can see that this is happening, right, we probably should be making some decisions on how can we optimize this to make this not as bad of a situation from a tax rate perspective. So here is where we show clients their details of their estate. So Mr. Client, based off our projections, which we look relatively conservatively, which I think when you're doing your estate documents, you may want to be a little more optimistic, but when you're doing your financial planning, we want to be conservative. But conservatively speaking, me and the wife are going to pass away with you and your wife are going to pass away with around $18 million. But that's a great amount of money. Most individuals would be proud of that as a legacy, but here's how it's going to impact your kids. Here's how it's going to impact your estate. The tax-free assets, these are the Roth that we talked about. 10 years, tax-free. They have to take it out within 10 years and it's tax-free to them. Tax-deferred assets, these are their IRAs, the pre-tax monies. So this $7.7 million now has got to be taken out over a 10-year period. $7.7 million ordinary income taxes over a 10-year period. So if you have one child, that's going to average it out. So that's $777,000 a year. It's a lot. What's that going to do to their tax bracket? Taxable assets, about $10 million. This presentation doesn't talk a lot about taxable assets as it passes through the estate, but no, these assets get what's called a stepped up in cost basis. So that's beneficial. And there's no requirements for withdrawal. As soon as they receive these monies, interest and dividends, capital gains, that'll be taxed to them. So it's not tax-free in the future, but it does help readjust the cost basis from yours to your date of death. What if we then have the analysis to say, okay, well, what if we think about doing some conversions here? Well, let's just bump ourselves up to the 22% tax bracket. Let's go to the 22 now and convert some money. So our projections, this year's 152. We see that underlined in 2024. Then based off of their financial plan, projecting 217, projecting 184 in the next subsequent few years. The question is, these are projections based off of how the tool is running your 1040 tax return behind the scenes, just a general 1040. But by doing this, the dollar amount's not changing, guys. We're still leaving the kids $18.4 million. That's great. But 6.5 now is Roth. $6.5 million is completely tax-free with an additional 10-year tax-free window. For our clients, when we consider this is the go-ahead to make these changes, but then we go work with our CPA to actually do the pro formas to give us the estimates of saying, okay, if we are doing 22%, here's the actual amount. So planning is working off of estimates, longer term. Our CPA, our team is living in the now based off of their current annual situation. But for something like this, you would say that this could be a benefit as leaving more money to the estate. It's going to help lower your required distributions because I'm paying more in taxes now. Okay, that's great. I'm paying more in taxes, but I'm paying more in taxes now to get a lower required distribution and helping my heirs out. What's in it for me? Well, in this person's case, we can see that it does change exactly what their impact on taxes are. So I'm going to increase taxes those first few years, but in the long run, it's going to be lower. And in fact, we can see that the total in the bottom right-hand corner projected that this individual saves about 600 grand in taxes. Yeah, right down here, actually, 616,000. Estimates, right, that you're paying less money on. So let's not be short-sighted here, right? Things like this could have a really big impact to your financial plan by executing and doing this. And especially now, taxes are going up, right? I mean, that's the thing. We just saw that unless anything changes, we know that these tax rates are going to go up. So we have at least 2 more tax years left to do a little bit more with these lower rates. How long do I got to live for this to make it work? Because, hey, we assume that you live to 90 there, right? In this case, this individual has to live to 2043, 2044 in order for to make this work. So longevity's on your side and you feel pretty good and happy and healthy. Again, nobody knows, but this could work. If it's the other way around, then maybe not. Maybe the numbers look good long term, but maybe it's not for you based off your own situation. All right. Lastly, tax loss harvesting, donor advised funds, and yeah, we'll go for a few more minutes. So these are non-retirement accounts. If I sell something at a gain between what I paid for it, that's a gain, capital gain. If I held it for less than a year, I pay ordinary income on it. It's a short-term capital gain. If I hold it for more than a year, it's a long-term capital gain. That's that 15-20% rate we saw earlier. If I sell something at a loss, though, I can now use that loss to offset future capital gains in that year. If I don't have a capital gain to write off or use against, I can just carry that to the next year. So when you have years, unfortunately 2022, where we see some bad performances in the markets, one of the things we can do to help, and we did for a lot of our clients, and you saw this, is harvesting losses, selling things at losses, accepting those, right? Because now I can use that for future gains, and I can be deliberate on how I use that. The one thing you have to avoid, though, is the wash sale rule. So if I sell something at a loss, I can't buy it right back. IRS is like, come on, we know what you're doing. So they make you wait 30 days. So assuming you wait 30 days, you can buy the sale back again and avoid the wash sale rule. Meaning if you did buy it back within 30 days, they're just going to disallow the loss and say you can't take it. So carry forwards, I can carry my losses indefinitely for my lifetime. And I also can use $3,000 of losses to offset my income for the year. Okay, let's talk a little charitable donations. We talked about qualified charitables. That was the 70.5, where you can deduct money from your IRAs as long as it goes directly to a charity. It has to go directly to the charity. That's not added to your income. You can go up to $100,000 a year per person to do this. And that's individually. So that's between you and your spouse. Another way to give to charities through the donor advised fund. So Schwab Charitable has a donor advised fund where you take either cash or appreciated stock, and you donate it to your own donor advised fund, your own foundation. You get the ability of naming it however you want. Once the money goes into that donor advised fund from a tax perspective, it would trigger the tax benefits for that specific year. Reason why you would donate cash, reason why you would donate appreciated stock instead of cash is I don't have to sell a security. I just pick up a security and put it in my donor advised fund. So if I was actually going to say, well, I'm going to sell this stock, I'm going to sell it because I want to give it to my charity. No, stop. Don't do that. Just give it to your donor advised fund. Or actually, you can even donate shares directly to the charitable organization. The donor advised fund's a lot easier and simpler because you can just do that through the site yourself. But you can take appreciated stock and put in the donor advised fund, and that is the market value of that security is what your deduction would be, or the ability to deduct. One of the things that I've seen clients talk about is the standard deductions, and they've gone up. And so these last few years, Maybe they haven't donated every single year, but one of the clever strategies that we've been doing is doing more, just funneling in, 3 to 4 years worth of your giving. So if I'm only going to give, or if I'm only able to give or want to give, say $5,000, $10,000, that's not going to help me itemize my deductions. I'm not going to get a true benefit for that. But what if I know that over the next several years, I'm going to do like 30 or 40? Let me just put 30 or 40 in my donor advised fund now. At least I'm getting a benefit here. And now I can gift the money out to my favorite charities through my donor advised fund. Also, the ability, once it's in the donor advised fund, you can gift it out immediately, or you can have the money invested. Completely tax-free. You get the immediate tax benefit. Plan for a charitable legacy. I just real quickly just want to mention this too. As we're talking about ways and sources of money that you're leaving, if you do have a situation where you are charitably inclined and you want to figure out what's the best source of money that you want to leave your heirs. And that previous example where that individual had large pre-tax monies to leave, one of the ideas you might want to consider is, I'd rather have that, or the money that I want to go to charity come from those pre-tax funds. Because the charities can get it, right, guys? And then they can just sell it without any tax implications. They're a 501c3. So I'd be thinking about, in a perfect world, my kids would get Roth, and then the non-retirement assets, and then the remainder amount of pre-tax assets that I'm not giving to charities. So just a quick thought there. When we're thinking about either donor advised funds, what you can set, and you can have the donor advised fund be your beneficiary of your IRA as well. So talk to us. That's what we do. Talk to us. So if you're new and you want to learn more about this and how this can impact you specifically, bogartwealth.com. You already got our information. You're watching this, right? So I'd love to get a chance to chat with you, run the numbers for you. That's all complimentary. We don't charge for financial planning. If you are an existing client and you want to know more of this about your advisor, if I'm your advisor and I said something that we haven't talked about before, let me know, right? Let's talk. We have some availability to chat, later on this week, if not next week. So this is just one factor of our retirement readiness series. If you're on here, I know some of you are consistently on here, we're core of what we do is education to our clients and to the public. And so list of items that we have on our website are right here. If there are topics that you're interested in, shoot your advisor an email. Love to hear something like this. We want to know what our clients are saying, right? Because if it's important to you, it's important to others. We want to make sure we're getting the word out, providing good education on it. bogartwealth.com/contact. That's where you can find us. All right. Thanks, guys. I don't think I had any questions come in. Hope you guys stay well. Thanks for spending the hour with me. Really grateful to be able to have this presentation, this conversation with you, and all the best to you and your family. Have a great day.